A couple beaten up media names see their stock prices and options volume pop, and a big investor, maybe the biggest, steps in. A fertilizer stock looks cheap and sees a big call buy, but some savvy investors have been recent sellers. A bumper crop or a poor yield? Those trades and some viewer questions tonight on Open Interest. Welcome everyone. Down roughly 16% peak to trough at the end of last week, the S&P staged a nice 2% rally today, despite Walmart's disappointing earnings, reporting $1.30 in EPS, missing street estimates by roughly 18 cents per share or 12%. The stock fell 12% by day's end. Walmart traded over 6.5 times the average daily options volume, most of that flow concentrated in options expiring this week, likely efforts to make cheap, levered bets that today's weakness may extend for a few more days. The more interesting question isn't where the most recently reported quarter disappointed, but where we might find some value in beaten up stocks. And for this, we may not need to look much further than the Oracle of Omaha, Warren Buffett. Berkshire Hathaway announced it had added Citigroup and Paramount Global to their portfolio. Both of these stocks got a big boost on that news, as did the options volumes in those names. I discussed the flow we saw in Citi on Fast Money earlier today, but I think the activity in Paramount might be more interesting. Personally, I own a small amount of it, and I'm kicking myself for not having bought more. Although a bit pricier than it was last week, Para is still only a third of the high that it reached in March of last year, and at 13 times earnings and making investments in streaming, it may still represent an opportunity, or so thinks one options trader who bought nearly 2,000 of the September 32.5 calls, paying $2.70 a contract. The space has been floundering since Netflix's disappointing results, and a lot of uncertainty persists. But buying longer dated calls and possibly selling some shorter dated upside against them may be a way to get some exposure without the same risk to the downside if today's activity proves to be a little more than a bear market rally. We saw similar activity in WBD, Warren Brothers Discovery, with a purchase of 10,000 of the June 22.5 calls for 19 cents. Now, those are pretty far out of the money and offer a very low probability of profit. Moreover, there's substantial open interest on that strike already, so it's unclear to me that this is the same value bet that Para is. Remember that Warner was a stub paid out to AT&T shareholders recently, some of whom may still want to dispose of it, perhaps accounting in part for the stock's very weak performance since the distribution. Personally, I owned T, actually I still own it, so I also received some of that WBD myself, and I actually added to it recently after we saw those steep declines on hope that the divestment selling pressure that we've been seeing might abate. Now, Warner Brothers Discovery has some great brands, but for the direct-to-consumer models that these companies are embarking on, this has been a tough row to hoe under the best of circumstances, and Netflix subscriber loss poured cold water on the whole space, turning it into a muddy mess. Nevertheless, for now, I'm at least willing to tolerate some EBITDA declines and a relatively high debt load on valuation and hopes that the company works their way through it. I personally just own the stock, though. I don't hold an options position in the name. Finally, one of the year's best performing stocks, but also quite volatile recently, Mosaic. The agricultural chemical company rallied 4% today, and we saw a large purchase of nearly 6,000 of the September 70 calls for $6. Now, Mosaic is up 67% since the beginning of the year and nearly 80% since May of 2021. That said, it fell about 28% peak to trough between the recent April highs and the lows on Monday, May 9th. Right now, the company is trading at less than 5 times the $13.83 a share the company is expected to earn for full year 2022, which I'm sure seems like a screaming bargain. It's worth pointing out, though, that cyclical companies can have very volatile earnings, and Mosaic earned just 32 cents a share in 2019. Some say cyclical companies will look cheapest at the top of a market cycle and richest at the bottom. For this reason, that may be why some big and savvy hedge funds that had been holders of the stock recently reported selling most, if not all, of their positions, and that includes names like Millennium, Renaissance, Appaloosa, and AQR, among others. So with implied volatilities as high as they are in the name right now, I would be inclined to spread any longer dated call purchases into diagonals rather than the outrights that we witnessed today. So with that, let's take some viewer questions. Scottsdale Finance asks via Twitter, Mike, every week on Options Action, I hear you say what is the implied move of a stock. I was clueless, but then I read about the rule of 16. Now I understand. So when I read this question, I realized that there's probably a lot of viewers out there who are unfamiliar with the rule of 16. And this is the basic gist of it. We often talk about volatility, we talk about implied volatility. What is implied volatility the way options traders usually refer to it? What it is the annualized standard deviation in terms of the price move. So if I say, for example, that stock ABC has an implied volatility of 32%, that means that the 1 year annual standard deviation is 32%. That means 68% of the time you're going to expect it to be within 32%, 90% of the time it's going to be within 64%. So if you want to think about the standard deviation in a shorter time frame, you need to adjust that number. And the way you do that to figure it out for a day is you divide by 16. Why is that? Because the function that we can use to adjust the standard deviation to a different time frame is to divide by the square root of time. Now, it sounds like it's very mathy, but it's really not that tough. There's about 256 trading days a year. Square root of 256 is 16. So you take the 32, you divide that by 16, and that gets you 2%. So the daily standard deviation is 2%. But this is a way to think about standard deviation. If you're thinking about the implied move, a simpler way, if you know that an earnings is coming up, say, next week, just take a look at the at-the-money call and the at-the-money put that expire next week. Add the two together, divide by the stock price. That's the implied move in percentage terms. Or you can just take a look at the absolute price, and that's how much the stock is expected to move. One other final point, this just for those who are interested in the statistics and math of it a little bit more. The standard deviation isn't actually the expected deviation of the stock, the average move, the mean move. The mean absolute deviation is actually the standard deviation times about 0.8. And sometime we'll get into a little bit more of the math on that, but that's just sort of some back of the napkin stuff that you can work through. Okay, our next question. Chartmaster Mike asks, if you're bearish long term, what's the best way to take advantage of these relief rallies in SPY and QQQ? Thanks. Okay, so it is entirely possible that rallies like the 2% rally that we saw today are bear market rallies. Some of the biggest short-term rallies you will see occurred during bear markets. We definitely saw that coming out of the tech wreck in 2001, 2002, and we've certainly seen it during the credit crisis and other instances, and actually even just during these recent declines. Implied volatility is elevated somewhat, but not too terribly. I think what we should probably be thinking about doing, and what I'm doing myself, is put spreads. And I will sometimes convert those into broken wing butterflies. And what's a broken wing butterfly? So if I buy a put spread, or I buy a ratio put spread, say a 1/2, and I'll just, we'll try to keep it simple and we'll use some examples. So let's say I bought the SPY 400 375 put spread. I might at some point convert that into a 400 375 365 put fly, where I'm long one of the 400s, short two 375s, and long one 365. The idea being that I'm trying to target certain levels. I can bring the premium down that way. I'm also anticipating, frankly, that there will be various levels of support as the market declines. We know that a lot of people have spoken very specifically about levels that they're targeting. 3850 in the S&P has been brought up a lot. 3500 thereafter, if we should break through it, are levels that people have targeted. So if you're using put spreads, think about getting long higher strikes and then short those strikes where you think it might drift down to. And the other thing I would also say is that if you do then see the market roll over and you see good sized profits on your hedges, or if they're just outright speculative bets, then on those, be sure to try to monetize them, at least in part. You can do that by rolling down or making other kinds of adjustments. If you own put out rights, you can then also look to spread them. And we actually talked in another video about rolling down and in. So in a real crash situation, sometimes implied volatility will rise very, very sharply. And if you think a crash is underway, monetize the bigger trades and then just take a smaller amount of that premium and just place it on some out of the money, really shorter dated puts. And that'll give you additional exposure if a real crash is in the works. But one of the things that happens in a bear market rally, this is not coming out of the blue. A lot of the bad news is well known. We've got Lloyd Blankfein coming out today and saying that he thinks that there's a very high probability of a recession. All of these things in conjunction with each other probably increases the likelihood that any kind of a bear market, if that's what we're in, is just going to get spread out a little bit more over time. We're not going to expect some sort of a flash crash type of event. Okay, so finally, the last question we get from Walt. Weeklies will provide the most theta decay, but you really don't get the premium. 2 weeks is decent, but what is a typical stop, take profit on options sells? I certainly don't want to hold until expiry and risk the shares outright. Okay, so it's definitely true that shorter dated options will decay more rapidly as a percentage of their value than longer dated options will. As a percentage of their value being the critical component in that statement. So you can take a short dated option and it's going to give up, a 1 week option is going to give up 100% of its extrinsic premium over 1 week because it's going to expire. But if the premium is too low, that doesn't necessarily create very attractive risk reward. So a couple rules of thumb for me, and let's just use a simple trade as an example. Let's say I'm in a buy right or a covered call situation. So I own the stock and I'm selling upside calls against it. I don't sell call options for less than 1% of the strike price, just as it's a personal rule. Also, I don't sell options against long stock unless I'm really looking to exit it, but that's generally not the case, that have a delta that's greater than 30. And preferably, I'm looking for something a little bit lower than that. Now, that's going to limit your options, pardon the pun, for the ones that you can sell, because you won't always find that that's the case. I also will not sell really long-dated options. So I don't typically sell options that expire more than 60 days from when I'm trading it. If I'm going to trade longer dated options, it's more frequently going to be that I own those and then sell near dated options against them. So what this tells us is that not every stock is going to set up really well for selling options. And then I would just say that there's also a current market condition that we find ourselves in, which makes this more difficult. So I already mentioned, for example, that I own Warner Brothers Discovery, received it as part of the stub in AT&T. The stock is down, I think it fell nearly 30% from when that was distributed to its recent trough, and it's obviously bounced back a little bit since then. I'm not going to sell close calls on a stock like that, because essentially what's going to happen is, for a very small amount of money, I could potentially be locking in a loss, and I don't have any interest. And also, it just makes it a lot more difficult in a volatile situation like this. If I own a stock, I should be comfortable owning it. If I start getting closer to levels where I would have been inclined to sell it on a valuation basis, but have not done so, maybe because I'm trying to make sure that I don't create a taxable situation. There could be a host of reasons why you don't do it. That's typically when I would start to sell some calls. Oftentimes, if I'm going to get short puts against a long stock position, meaning that I would be willing to add to it, again, that's going to be done more on a valuation basis, not just simply a function of how much premium is in that option and how much time to expiration. So I'm looking for technical levels, I'm looking for valuation levels, and then I also have those hard and fast rules where I'm just not going to sell options for less than 1% of the strike. Just the risk reward, it's not even worth looking at from my point of view. Finally, with respect to stops and with respect to taking profits on the short side, if I'm short an option and I see this thing go 50% against me, I'm almost always going to look to get rid of that. That's a situation where I'm getting close to probably getting at the money. I don't want to see these situations where these options get really deep in the money, and usually your first loss is your best loss, because chances are, if you start seeing those kinds of losses, something about your thesis has been violated. The only exception to that being situations where I was hoping to actually get called away from the stock, in which case I'll just let it ride out. And on the take profit side, sell a call option for $1 against a $20 stock, collecting a decent amount of premium. That thing gets down to a nickel. That's the other time you definitely want to take profits. People will indicate, look, the chances that that thing ends up in the money is virtually nil. My own take on this is I don't want to look at it. I don't want to have a lot of situations where I just have, options that are a nickel or a dime. I could close those out, free up the capital, not have to look at those things on my sheets. It's just not worth it. So how much that premium is going to depend a little bit on how much the underlying stock is. So if you're looking at a stock like Amazon, you don't wait until the option gets down to a nickel, because we're thinking about it in percentages of the share price. But the fact is that once you get, say, 80% of the premium you sold, I think it's a decent time to consider closing or maybe rolling might be a way to make sense. I hope that helps you. Thank you guys all very much for tuning in to the Open Interest, and I'll catch you on the next one.